All right. Good morning, good afternoon, traders. Today is Wednesday, December 18th, 2024. It is. You've got options for Income Navigator. And today I briefly want to talk about the covered strangle. This is something that has come up in the last couple of days. I put on the trade in TLT. And, there were some questions. I think there were some good questions. And even though, there's a ton of information already in the Discord about the strategy, I want to share my thoughts about the strategy and what I'm planning on doing with my trade in TLT. First, I wanted to show you guys something. And again, I'm not an expert in fixed income trading by any means, but I did find this chart here, specifically Treasury yield curve, and we're going to look at the yield curve. This is Treasury rates at different maturities. Current, which is the blue line, right? We can see that December, we're at 4.325. 3-month Treasuries are slightly higher, 3.53. And so on, all the way out to a 20-year and a 30-year. What I want to show you guys is what the yield curve looked like in, right, this orange line is September. We know that we had an interest rate cut in September. And what I would like to do is maybe we'll get rid of November too. Compare the shape of these two lines, right, the yield curve, in these two different times, current yield versus September yield. So we know that from September, there's another expectation that we're going to get another 25 basis point cut today. And we can see that since September, the front end of the yield curve has come down, right? Rates are down, but interest rate cut looks like it pushed rates on the longer end of the yield curve are actually higher today relative to where they were, right, just a couple of months ago, back in September. You can see that 20-year was at 4.19 and today is at 4.68. So the longer end of the yield curve is up, shorter end of the yield curve is down, right? So when we trade TLT or ZB or whatever, bonds in general, right, the idea, and we talked about this, myself and Ed, Notional Ed, this was maybe about a month ago, and we have a video up on YouTube and on Discord about how Fed moves affect the yield curve. And the general idea is that when the rates come down, right, bonds are going to go up, right? They have an inverse relationship. Rates go down, the price of the bonds go up. So we would expect that as rates come down, the price of TLT, ZB, whatever fixed income instrument you may be trading, those prices should be pushing higher. Now, what I want to show you is that as rates came down, right, the yield curve has changed, and we can see that 20-year rates today are higher than they were back in September. So what does that mean for TLT, for example, right? TLT is a 20-year bond ETF, right? So it's a 20-year plus, 20, 30 Treasury bond ETF. So if the rates on the 20-year plus, 20 and 30, if the rates are higher, the price of TLT is going to come down. And that's exactly what we have been seeing. I'm going to share my Option Explorer to show you what the chart, and this isn't the best charting software, but it's not hard to see that back in September, TLT was, right, early September, TLT was at around 97. And as we were headed into the rate cut, which was around September 18th, right, bonds were rallying in the expectation that rates will come down and price of the bonds will go up. However, ever since that cut, TLT has sold off. And the reason for that is because the yield curve on the 20 plus treasuries actually has gone up. Now, I don't know if this is going to continue after today's rate cut, if the longer end of the yield curve is going to continue to rise. I'm not making the case for the rates to go higher or lower. It really doesn't matter to me. But the reason why I decided to go with TLT is because at some point, right, we don't know when. This is what TLT has done over the last, 3 or 4 years. Now, I'm not calling the bottom, right? But I think we're at a point where a trade in TLT kind of makes sense. And the trade, some call it triple income. I think the proper term is covered strangle. And the reason why it's a covered strangle is because, as we know, the strangle is a short out of the money put and short out of the money call. And short out of the money call is naked. The put is naked too, but it's backed by a cash position that will be used to buy the shares. But the call is naked. And as we know, the risk on the upside is literally unlimited, right? The underlying could go up into infinity. So to cover the risk on the upside, we would either buy the stock, right? So this would be a covered call with a short naked put. It's the same thing as a covered strangle. Or what I like to do, instead of buying stock outright, I would sell an at the money put with a very short duration. This is the trade that I chose to do. This is trade was put on yesterday. So the front month is where I sold an at the money put, or close to at the money, was at 90 strike. I am selling this put with an intention, right? I'm not going to roll with it. I'm not going to fight it, hedge it, and none of that. I sold this put with intentions of actually buying the stock at 90 minus whatever credit I collected. I believe it was 55 cents. So if I get assigned on this 90 put, my cost basis are going to be $89.45. Right? So from there, I will own the shares at around 90. And I also have a strangle that I sold. Oops. That strangle is in January 17th expiration. I sold an 87 put, a little bit farther out of the money. This one is currently delta about 15. And I sold an out of the money call at around, now it's delta 11 or 12. Okay, so I sold an at the money put looking to get assigned. I could have just bought the stock outright. Instead, I sold an at the money. It's kind of forcing myself. I could have went slightly in the money on the front month if you really wanted to get assigned. But I think 90 is an okay level to own this ETF. Doesn't really make a difference, 90 or 91. The point is you sell the front month to buy the shares. One other way this could be done is instead, let's say a 90, we can do like a stock replacement, right? Where we sell, let me try to draw this out. And this is probably a little bit more efficient from a margin requirement standpoint. But I think the best way to do this is just, if you're going to buy 100 shares at 90, just have $9,000 in the cash account allocated towards this strategy. If you're going to do it in the portfolio margin, obviously your requirement is going to be much lower, but you have to kind of, plan for it as far as capital goes. You have to understand that if you get assigned, you need to know how much money you need to have in your account in order to hold shares long. So you can get a little bit fancier and go, instead of buying stock outright, right? Selling a 90 put is not really a stock replacement, right? This is more of an at the money covered call, right? Because our upside is capped. But if we wanted to do a stock replacement, right, this would be more of a synthetic long stock position. We're short 90 put and we're long 90 call, right? This is going for about a 40-cent debit, but the requirement is still going to be, whatever your broker is going to ask to hold the 90 put short. So we could have done it this way. So we are selling a 90 puts, buying a 90 call, and then going out maybe 30 days out and selling a strangle at around 1 standard deviation away. Right. So this is what this position would look like. So we have a lot more directional exposure. The problem, and one of the reasons why I didn't do it is because if we choose to go with a synthetic long, there's really no great benefit other than maybe you'll save a little bit on the margin requirement and whatnot. But if there is a dividend coming up next week, you're not getting it. You actually have to own the stock. So there's no real incentive for me to do a stock replacement and get long 100 shares. Instead, what I chose to do is I sold the 90 put with intentions of actually taking the stock in the next 2 weeks. If we settle or end up somewhere below 90, I'm going to own shares at 90 minus whatever credit I collected, and then I'll have a short strangle on top of my long stock position or long ETF position. Now, what I really want to stress is that, whenever we introduce something like this, as far as strategies go, they could make a lot of sense because, look, in this position, if I get assigned shares of TLT, right, TLT right now has a yield of 4.66%, which is not bad, right? You get 4.66% in dividends just holding shares long. That's one income, right? I'm selling a covered strangle, which means that I'm either going to sell the stock at a higher price. That's my short call, right? This call is covered by long stock. So I'm going to get out of my position at a profit, right? This will be a capital gain. So that's income 2. Or if I don't get called away, that short strangle is going to drive more income because I'm selling a call and a put out of the money. That's income 3, right? So I have the dividend, I have the potential capital gain by selling shares at a higher price, and I am collecting a credit for selling an out of the money call and a put or a strangle. So those are 3 incomes. This is why I refer to this as a triple income strategy. And it makes a lot of sense, right? It makes so much sense that sometimes people say, well, you know what? Let me go and find something that yields 15% and I'm going to juice up my yield by, owning shares, selling strangles, this, that, and the other. But the reality is that the first thing you want to think about when trying to apply this kind of strategy is, this is question number 1. Do you actually want to own the shares? In my opinion, and I can be wrong, but in my opinion, anything that pays a 15% dividend, it's not sustainable. They're either borrowing money to pay out this high dividend, or it's just a matter of time until that dividend is going to get cut. It doesn't make sense, right? It a lot of times, if it's too good to be true, it's too good to be true. 15% yield is not sustainable for any company, any ETF. There's some kind of accounting going on that is going to catch up with this company. It's just not going to work out in the long run. Now, I have to believe that owning shares of TLT with a yield of 4.66%. If the price of TLT goes lower, that yield obviously is going to be a little bit higher, making it more attractive. And I don't think that there's any funny accounting going on in TLT. They're just paying out whatever the long-term treasuries are paying. And right now, this 20-year plus treasury bond ETF is showing a yield of about 4.66%. And if I just go back real quick to the chart I was showing you earlier today, current yield on the 20 plus, so 20-year treasuries are paying 4.68%, 30-year are paying 4.59%. So it's very close to what TLT is paying out. I don't have any evidence to believe that there's some funny stuff going on and this yield is going to get cut. Now, granted, if long-term rates are going to fall, right, this yield in TLT is going to come down. But at the same time, as we know, since the rates and the price of TLT have an inverse relationship, as rates will come down, the price of TLT has to. It's not a matter of opinion or do you think it's going to happen. They're moving in the opposite directions. If rates come down, if yields goes down, the price of TLT should go up, right? So we have a potential for capital appreciation here with short calls. If rates come down and TLT goes up, we get called away in our position. If TLT goes down because longer term rates are going higher, we're short puts with an assumption. Again, we talked about rolling naked puts, and this doesn't apply here. You don't want to put yourself in the position where, you sold a 90 put, TLT goes to 89, it's in the money. Now you're scrambling, looking for ways to roll out and in, and it doesn't apply here, right? You need to have a very clear plan and you have to know exactly what you're going to do if A, if B, and if C. And when it gets to A, B, or C, you have to do exactly what your plan says you have to do. There's no, looking around asking, does it make sense to roll here or there? And I think that doing these kind of trades, you just have to follow along with the plan. And if owning shares at 90 or at 89 or at 85 isn't something that you want to do, right? If this isn't something that you would want to hold in your retirement account for the next 5 years, then I think that this underlying would be the wrong underlying to do this strategy. So to circle back, this strategy starts and ends with the underlying that you would be okay with owning in your retirement account for the next 5+ years. There is a chance, right? I'm not making the case that this is what's going to happen or it's not what's going to happen. But if you were doing this trade in 2020, if you were doing this trade in 2021, right? We haven't seen those prices since. And if you were buying shares to do this strategy somewhere in 2021 at around 150, now you're at 90, it shouldn't bother you. The problem is that if you do this trade, let's say at around 90, you get the shares at 90 and it continues to roll lower. Now, where are you going to sell that covered call, right? A part of that strangle is a short call, which is covered by the long shares. Where are you going to sell? At what price or at what strike price is your covered call? Your covered call has to be above your cost basis. Otherwise, if you sell a call below your cost basis, your best case scenario, you're going to lock in the loss, unless, and I want to deviate into that. If you're looking for a loss for tax purposes or for whatever, typically you don't want to sell a call below your cost basis to get called out of your position and realize a capital loss. Right? So keeping track of your cost basis is going to be very important too. So you have to know where your cost bases are. And in case something like this continues, right? So it looks like we're kind of, I mean, again, I don't want to project or give you an idea that I know what's going to happen to shares of TLT, but, we're still kind of, there's no question we're in a downtrend here, but you can see that the rate of change is changing, right? But now we're kind of maybe building a base here, right? So I think the downside is not as great, but you have to assume that if things continue to roll lower, you have to have capital where you're potentially are going to buy more shares at, maybe you bought them at 90, maybe you'll buy more at 80, at 60. I don't know, but I don't think TLT is going to zero. So at some point when it stops going down and maybe just trade sideways, which is going to be like the best thing for this strategy, because a sideways market means that you're sitting on your long stock position, you get the dividends, you're selling a strangle, which is out of the money call and out of the money put, which will likely to expire worthless. So you're getting two incomes, not three, right? You're not realizing a capital gain because you're not getting called away from your shares, but you collect the dividend, you collect the premium from the short strangle, and these two incomes will go towards offsetting your cost basis. So if we go for 2 years in the sideways market, right, something like this, where you actually get to sell premium far out enough on the upside and on the downside, and you get the dividends and you get the premiums from your short strangles, you can work your cost basis way down, right? And then if you choose to sell some of your position, if as long as you know where your cost bases are, you can sell an out of the money call, maybe a little bit closer to at the money, because you actually want to sell some of your position, some of your stock, right? So you move your short call a little bit closer to at the money, you get a higher premium in exchange for that. And if you still don't get called away, now you're, again, reducing your cost basis. You could do it every month. You can do it every 2 months. The duration on that strangle is totally up to you. I don't think there is a right or wrong way to do it. I think that, we talked about, the window where selling premium makes most sense. In my opinion, it's somewhere between 30 and 45 days, right? You can go as high as, there's been some data that's out there that it's suggesting that 56 to 45 DTE is the window where it makes most sense. I think it's 30 to 45, but it doesn't matter, right? You can sell something 2 years out, but the decay of that premium is going to be so slow that it, in my opinion, it doesn't make sense to go too far out in time as far as your short strangle goes, right? You want that short strangle to decay pretty fast enough for you to be able to work down your cost basis. Going out 2 years, yes, you're going to get 2 years worth of time premium. So you're going to, reduce your cost basis pretty substantially, but you have to hold it for 2 years waiting for that strangle to come off. Right. So everything is a trade-off. I don't believe there's a right and wrong. I think there's just, there's two sides. Go out longer, collect more premium, but you're stuck in this strangle for longer, or go shorter. You take less premium, but you're going to turn that over a lot more times if you choose, these 30 or 45 day windows instead of going out 2 years to sell a strangle. So this is what this trade looks like right now. It did absolutely nothing in the last day. We can see that the price of TLT is down, I know, 0.7 standard deviations, but it's just 1 day, so it's not really that big a deal. This is the darker gray area is the expected move over the next 13 days. So if we move to the downside, I will take the stock. I will have a short strangle, which means that I'm either going to buy more shares at 87, or if I own the stock, let's call it at 89.50. If it rallies, I have the 95 call that is sold in January 17th expiration cycle. So if we rally, and we can probably see what January expectations are, we're going to be somewhere, right? This is the standard deviation, somewhere inside 90, let's call this just over 93 or just below 87.5, right? So if I get put stock at 90 and then by January we rally up to 93, that 95 call will then expire worthless. That 87 put will most likely expire worthless if we're inside the expected move, what is currently expected by third Friday of January. So I will have collected the premium from the short strangle, which will go to further offset my cost basis on my long stock position. I know I just went on for a while, and hopefully this is clear. And if you guys have questions, if you want to ask a question, um, you probably can unmute yourself. You can unmute yourself, or you can ask in the chat box, and I'll try to make it maybe more clear. I know Tom talked about doing similar strategy with ES or MES, right? Which is not a terrible idea either, as long as, right, when you initiate any covered strangle, right, look at the Greeks. So you have positive delta, which means you have to be bullish on the price of the underlying, right? If you're not sure if it's one of those, and I remember, just not too long ago, a couple of years ago, in 2021, we had some high flying, the Pelotons and the Teledocs and whatnot, right? These stocks were like the best thing since sliced bread, and everybody wanted in. And again, if you take the right strategy and you apply it on the wrong underlying, you can potentially put yourself in a very tough position. Again, I'm not trying to pick on Peloton for any specific reason, but right in 2021, this was a high flyer, right? 2020, everybody was stuck at home on their bikes, and then right, everybody wanted in. So if you thought this, triple income was a great strategy as the stock was up, every single day back in late 2020 or in 2021 when it was hitting all-time highs, and this was going to become, the next Google, it wasn't, right? And if you got stuck here, right, it lost, I don't know, 90% of its value at some point. So not only you can't, sell a covered strangle because you're way below your cost basis. So now, best case, you're holding on to the stock. I don't think that Peloton pays a dividend. So you have no income from the strangle. You have no dividend yield. So you have no income holding the shares for the last 2 years. You can't sell the strangle. You have no dividend. And that's all because, and I'm not saying that Peloton's a bad company. I'm just saying that it's the wrong strategy for Peloton, right? So before you do any kind of covered strangle, you want to think and ask yourself, do I really want to own shares? Would I be okay if the shares were put to me and I had to hold them for, 3 years, 4 years, 10 years? Right? I don't know if Peloton's going to be around in 10 years. Maybe they are. Maybe they go back to all-time highs. Maybe they go out of business, right? So I'm not really sure about that. I would probably do it with, if you want to be a little bit more aggressive, if, your time horizon allows for it, like you can do it with stocks like Amazon, for example, or Apple, right? I think these companies are going to be around for a while. And if you think that they're going to be around in the next 10 years and you want to be aggressive with your income from this strategy, so you apply to a little bit more aggressive underlyings, it's okay. But companies that kind of, they're here today, not sure where they're going to be in 2 or 5 years from now, I wouldn't do it. It just doesn't make any sense. There are other strategies that are much better suited for those kind of companies. So you have to be very careful when you're selecting the underlying for this kind of strategy. If you do it on ES, that's fine. I think the market's going to be here. Maybe we'll go higher, maybe we go lower. I don't know, but I think it's going to be around for a while. And, most of the time, right, we have to assume, I don't know how far back we can go on this software here, but, just look at the chart of SPX. And you can do this on your own. Just type in SPX in your chart and then zoom out as far as you can go. We have to assume that this asset over time, sure, there could be times where we go into, downtrends, maybe no trends. But over long periods of time, the market is going to rise. So I think that this definitely works on SPX. I think it definitely works on underlyings that are going to pay a dividend and underlyings that you wouldn't mind owning shares outright. If you, for example, if you have an underlying that goes down and you're stuck in it for 2 years and you aren't able to sell a Strangle because it's way below your cost basis, you can also, maybe instead of selling a Strangle, you're just selling a naked put with intentions to buy more shares to reduce your cost basis. And you get the dividend. So you don't get the two incomes, you get one and a half. You get the dividend and you get a half income from selling additional naked puts. And then eventually, as you work your cost basis down, you will be in the position where you can start selling, instead of just naked puts, you could start selling Strangles again, right? Because now you have reduced your cost basis down to where selling calls as well as puts make sense. But if you're way below your cost basis and you're only going to collect maybe a nickel for selling that short call, maybe it makes sense to you, maybe it doesn't, right? So a lot of discretion needs to be applied here. But the idea is you have to keep track of your cost basis so that you're not selling a Strangle where, in the best case, if you get called away, you're just going to realize a loss. So for me, with this trade, I sold the 90 put. I'm going to wait it out until, the expiration, which is December 31st. If it's in the money, I'll take the shares and I'll deal with the Strangle. Great question. I saw someone asked, what happens if the underlying is rallying and it's running over my short 95 call before I get the stock, right? I don't want to end up being short 95 call with no stock. Having these naked puts at 87 and 95 is 90 at 90 and 87. These naked puts are great. They're going to lose value, but they're not going to go straight to zero. For as long as there's time, they're going to be worth something. But if we start to rally hard and we get above 95, right? I don't have the shares, but if I let them expire in the money, if I let this 95 call expire in the money, I have to deliver stock, which means I will have to go to market, buy the shares at whatever the price may be. I don't want to buy the shares at 100 only to have to sell them at 95, because that loss isn't going to be covered from the premiums I just collected from the 90 and 87 put. So I do need to be aware of, where is the price of the underlying right now and what does my risk graph look like? So for example, I look at my T+0 line, right? So today, in the position that I'm in, I am equivalent of being long 257 shares. And then as the underlying starts to rally, right, at 91, I don't have a problem. At 92, I don't really have a problem. At 93, right, even though that 95 short call is still out of the money, but now I am short, right? At 93, I'm equivalent of being short 117 shares, which means this position is going to, if we continue higher, this position, the short coverage strangle, is going to be losing money, and my 95 call is coming under pressure. So what do I need to do? These puts are still going to theoretically lose money, but it's not going to be much. They're just sitting there doing absolutely nothing for me. So the first thing I would probably do is take my 90 put, right? It'll probably lose 2/3 of its value. Not that there was a lot of value to begin with. They sold it for 55 cents. How much value can it lose? But it's no longer useful for me, so to speak. Only 13 days to go, and the price is running away. I would probably roll it from 90. And again, I don't want to sound like a hypocrite, right? I said no rolling, no nothing. But in this case, I'm not rolling because I'm trying to save this short put. I'm actually just getting a little bit more aggressive. I would roll it to like a 92, right? Where the price is at 93. So I'm, potentially dragging this short put closer to at the money, forcing this position to assign shares to me. Hopefully that makes sense, right? So, and I'm just doing that because the 95 call, if it goes in the money, I need to have the shares. Instead of rolling this 90 put higher, I can just say, you know what, I'm going to buy the shares. And, if 95 goes in the money, the shares I bought, I will get rid of those shares. If I buy the shares when the stock is at 93, so I'm buying shares at 93, I get called away at 95, that's a gain. The 90 expires worthless, that's a gain too. Right? So that's kind of like my game plan, right? And again, I like to have the discretion to decide. I know that, everybody wants kind of written plan. If A, then B, then C, then D, but it doesn't really work that way. And you don't want to, just learn a strategy and follow someone else's rules that they wrote. You want to have your own rules. We're all going to be trading very similar strategy, but we also want to learn to think about, what's happening. What can I do to improve my position? Right. So, who am I to say that, if you sold a 90 put and stock goes to 91, you have to roll that 90 to 91 to make it at the money, right? Because now if the stock goes to 89 real quick, what are you going to do? Now you're going to roll this 91 back to 90. You're going to frustrate yourself, and odds are with the slippage, you're just going to create more problems for yourself than you need to, right? But I know that at 93, where I have a net short delta in this position, and I could still do nothing, maybe, right? Depending on how fast we're moving and what's happening in the market, maybe I do nothing, but I definitely don't want to watch the underlying go above 95, and I still don't have the shares. And these naked puts, they're not losing a lot of money, right? So they're really not doing a whole lot for me. So first thing I would want to do is drag them closer or just buy the stock outright and give it some time, see what happens. Right. So that's kind of my idea. And then if I'm long shares and the strangle goes out, right, at the January 17th expiration, if we are inside of the expected move, right, 93 down to about, 87 and a quarter. If my short strangle expires worthless, I will then continue to hold my shares and sell another strangle somewhere between 30 and 45 days out. I will know what my cost bases are. I will input all of that information into Option Explorer, which will keep track of my break even and all of the credits and all of the debits and whatnot. So I know exactly what my cost bases are. And if the short strangle that I'm holding right now in January 17th expires worthless, I will then go out and sell another strangle, collect a credit from a short call, from a short put, give it, if it's going to be 30 or 35, 40 or 45 days, whatever the time is. And if that strangle expires, I will have to then go and adjust my cost basis once again and sell another strangle. And if the underlying goes lower, I will either buy more shares at a lower price, right? Or I'm going to get called away from my long stock position. So it's very simple. I'm going to try to. I know there is one already out there. I don't want to take credit for somebody else's work, but there is a chart that kind of shows the steps of this triple income strategy. I believe there's one from Gavin from Options Trading IQ, or I believe that's what his site is. And yeah, it's a very simple game plan. You know, you either buy the underlying and sell a strangle, or you can instead of buying the underlying, you can just sell an at the money put and sell a strangle around it. You know exactly the outcomes. If the underlying is higher, whatever's going to happen. If the underlying is lower, then something else is going to happen. You know exactly what is going to happen in either of the scenarios. And from there, you have the step number 2, which is either sell another strangle against your long stock or whatnot. Maybe you don't want to buy any more shares and you're only going to hold shares and sell an out of the money call, right? But that's for you to decide. No one is going to tell you what is right for you. You want to understand how the strategy works, and you have to apply what is best for you based on your needs and your goals.